At Canada Life, we can help you plan how your assets are passed down to your loved ones. The first step is to understand inheritance tax, IHT for short, and whether you're leaving an IHT liability. Inheritance tax is paid on the value of the assets you leave behind when you die. Think about your house, belongings, and money in the bank, as well as jewellery, cars, shares, and payouts from insurance policies. It can also apply to gifts made in the 7 years before your death. You need to know if the total value of these assets is more than £325,000. This is called the nil rate band. Anything over this amount may be liable for up to 40% IHT. On top of the £325,000 nil rate band, there's an additional home allowance of £175,000, often called the residence nil rate band. Adding these two amounts together means a single person could potentially leave up to £500,000 without an inheritance tax liability. To qualify, you must leave your home or assets from the sale of your home to direct descendants, such as your children, grandchildren, or great-grandchildren. In other words, you won't qualify for this allowance if you leave property to siblings or cousins. Also, if the value of your property is more than £175,000, or the value of your estate is over £2 million, you'll only partially benefit from this allowance. So, how much inheritance tax will you end up paying? As explained earlier, if you're single, you have a nil rate band of up to £500,000, and any amount over that may be liable for up to 40% inheritance tax. But if you're married, or in a civil partnership, the assets you leave to your spouse or civil partner are free from inheritance tax and don't use up any of your nil rate band. Then, when your spouse or civil partner passes away, their estate could potentially claim a £1 million nil rate band, as your unused allowances can be transferred and used against their estate. Remember, this benefit is only available to your spouse or civil partner, and not available to cohabiting partners. When must all this be paid? Any inheritance tax must be paid by the end of the 6th month after your death. This can be challenging if your estate holds assets that can't easily be sold, like a house. All of this can be worrying, as no one wants to burden loved ones with an inheritance tax bill. But that's where a professional advisor can help. If you think you might be affected by inheritance tax, speak to your advisor who will be able to discuss the options available to you. Some of the most common approaches to decrease inheritance tax include putting your assets into a trust for your heirs, leaving a legacy to charity, paying into a pension instead of a savings account, using exemptions. Each year you can gift up to £3,000, which is useful if you have surplus income, and lastly, using life insurance to pay the tax. At Canada Life, we have a range of trusts and life insurance solutions that can help you plan how your assets are distributed and how to pay inheritance tax after your death. Speak to your advisor or visit our website.